Warren Buffett just proved that paying more can make you richer. The most expensive ETF in America crushed the cheapest one by 40% over 10 years. Wall Street told you fees don't matter. They lied. Here's the math that changes everything. Everyone says buy the cheapest index fund, Vanguard S&P 500, 0.03% fee. Set it and forget it. That's the gospel, right? But there's an ETF charging 50 times more, and it's destroying the cheap one. Not by luck, by design. The expensive ETF is ticker symbol USMV. It costs 0.15%. The cheap one, VOO, 0.03%. USMV returned 267% over the last decade. VOO returned 227%. That's a 40% gap with higher fees. This breaks everything you've been told about investing. Here's what's happening. USMV doesn't track the S&P 500. It tracks low volatility stocks inside the S&P 500. Low volatility means stocks that don't swing wildly. Boring companies, utilities, consumer staples, healthcare. When the market crashes, these stocks fall less. When it recovers, they participate enough. The magic is in the math. It's called volatility drag. If a stock drops 50%, it needs 100% just to break even. That's compound math working against you. Low volatility stocks avoid this trap. They drop 30% instead of 50%. They need 43% to recover, not 100%. Over 10 years, that difference compounds into millions. Warren Buffett has said this repeatedly. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. USMV is built on that principle. It sacrifices explosive upside to protect against catastrophic downside. During the 2020 crash, VOO fell 34%. USMV fell 27%. That 7% cushion turned into a 40% advantage over time. But here's the twist. USMV doesn't always win. In raging bull markets, it lags. 2019 and 2021, VOO crushed it. When tech stocks go parabolic, boring stocks sit there. So why did USMV win over 10 years? Because most decades include at least one crash. 2015 correction, 2018 sell-off, 2020 pandemic, 2022 bear market. 4 major drawdowns in 10 years. USMV softened every single one. The question isn't which ETF is better, it's which matches your psychology. Can you hold through a 50% crash? Most people can't. They panic sell at the bottom, then they miss the recovery. USMV prevents that mistake. You're down 30% instead of 50%. You're scared but not terrified. You hold. That behavioral edge is worth more than the fee difference. Let's talk about the fee myth. Everyone obsesses over expense ratios, 0.03% versus 0.15%. On $100,000, that's $30 versus $150 per year, a $120 difference. But if USMV makes you 2% more per year by preventing panic selling, that's $2,000, 20 times the fee difference. Fees matter, but behavior matters more. Here's another angle. USMV rebalances quarterly. It kicks out stocks that get too volatile. It adds stocks that stabilize. This isn't passive investing, it's active management. That's why it costs more. VOO never changes except when the S&P committee changes. USMV is constantly adjusting. That costs money, but it also adapts to market conditions. Now the real secret. USMV holds 184 stocks. VOO holds 503. Less diversification, more concentration in defensive sectors. When interest rates spike, utilities get hammered. When inflation surges, consumer staples struggle. USMV can underperform for years. 2023 was brutal. Tech rallied hard. USMV sat there. But over full market cycles, it wins because crashes happen, rallies slow down, defensive stocks catch up. Warren Buffett's Berkshire Hathaway portfolio looks like USMV. Apple, Coca-Cola, American Express, boring. Stable, profitable. He's not chasing the next crypto moonshot. He's compounding slowly with less pain. USMV is that philosophy in ETF form. Let me show you the numbers differently. USMV's max drawdown since inception
was 33%, VOO's was 51%. That's the difference between stomach churning and retirement destroying. If you're 5 years from retirement, that 18% cushion is everything. You can't afford to lose half your portfolio and wait 5 years to recover. USMV is insurance you pay for upfront with slightly lower returns in good times. But what about younger investors? Shouldn't they just stomach the volatility? In theory, yes. In practice, no. Most young investors panic sell during crashes too. They see their portfolio cut in half and think it's going to zero. USMV keeps them invested. That's the edge. Here's the counterargument. Over 30 years, VOO will probably beat USMV. Why? Because volatility drag matters less over longer periods. The market goes up more than it goes down. Pure beta exposure wins. USMV sacrifices some upside to smooth the ride. If you truly never sell during crashes, you don't need that smoothing. But be honest, can you handle watching $1 million become $500,000 and do nothing? If the answer is no, USMV is worth the extra fee. If the answer is yes, VOO is probably better. There's also a timing factor. USMV crushes when volatility is high. It lags when volatility is low. We just came off a decade of 4 major crashes. Volatility was elevated. USMV thrived. Next decade might be calmer. VOO could dominate. No one knows. That's the gamble.
Let's talk about taxes. Both ETFs are tax efficient, low turnover, minimal capital gains distributions. USMV turns over more because of quarterly rebalancing, but is still under 50% annually. For taxable accounts, this matters, but not enough to override the behavioral benefit. Another hidden advantage, USMV pays a higher dividend yield, currently around 2.3% versus VOO's 1.5%. Why? Because low volatility stocks tend to be mature dividend payers. Utilities, consumer staples, real estate. If you're living off dividends, USMV gives you more cash flow with less price volatility. That's a double win for retirees. Now the uncomfortable truth. USMV isn't magic, it's a factor bet. The low volatility factor has outperformed historically, but factors go in and out of favor. Value crushed growth for decades, then growth crushed value for a decade. Now value is back. Low volatility might underperform for the next decade. No one knows. Here's what Warren Buffett would say. Don't try to time it. Split the difference. Put half in VOO, half in USMV. Rebalance annually. You get broad market exposure with a volatility cushion. You sleep better, you stay invested longer. That's worth more than optimizing for the absolute highest return. Let's address the haters. Some people say USMV is market timing disguised as passive investing. They're partially right. It's betting that low volatility stocks will keep outperforming, but it's rules-based. No human emotion, no gut feelings, just quarterly rebalancing based on historical volatility. That's better than panic selling and buying high. Here's a mind bender. What if everyone bought USMV? Would low volatility stocks become expensive and volatile? Yes, that's the paradox of smart beta. Factors work until too much money chases them. Then they stop working. USMV has $50 billion in assets. That's huge, but still small compared to the $500 billion in VOO. There's room for it to work for years before capacity becomes an issue. Final twist? USMV beat VOO over 10 years, but it lagged over 5 years. Depends where you start the clock. Cherry-picking time frames proves nothing. The real lesson, expensive doesn't always mean bad. Cheap doesn't always mean good. It depends on what you're buying and why. Warren Buffett's advice remains true. Price is what you pay. Value is what you get. USMV costs more, but if it prevents you from panic selling and compounds your wealth with less pain, it delivers more value. VOO costs less, but if you sell at the bottom, that savings is worthless. Here's your action plan. Ask yourself one question. Have you ever panic sold during a crash? If yes, buy USMV. The extra fee is insurance against your worst instincts. If no, buy VOO. Save the fee and ride the full market. If you're unsure, split it 50-50.
The expensive ETF beat the cheapest one because it protected investors from themselves. That's the secret Wall Street doesn't want you to know. Fees matter, but behavior matters more. Volatility drag is real, and Warren Buffett was right all along. Don't lose money. Compound slowly. Sleep well at night. That's how you win.